Hi, in this video, we're going to go over brief basic examples of how to construct aspects of a cash flow statement using the income statement and the balance sheet. In particular, this video kind of is a proof of netting accounts because some of you watch us create an income statement and balance sheet and wonder, really, can we net accounts and really does it get us to where we need to be? And I need to understand the mechanics of how these things work. So this video is meant to explain that. So if you already have this, if you've already nailed kind of netting accounts, creating in the cash flow statement on the balance sheet, then this video you might want to skip over or watch double speed. Otherwise, watch this video to just kind of understand how the mechanics and components of it work. So we have here an income statement and a balance sheet. And we have sales of 8 million, cost of goods sold of 6 million, SG&A of 300,000, depreciation of 500,000, and net income of 1.2 million. We've been asked to create a cash flow statement of operating cash flow. So we're going to create that part of the statement right here as an example. And I have a balance sheet with a couple of accounts on here. Now this balance sheet isn't a complete long list. It's just meant for this example. Balance sheets usually have more components than what is listed here and usually some in total. So I just do this. This is just for this example. So we have balance sheet accounts where we have beginning inventory, that's at the start of the year, and then ending. So the question is, how much did we collect from customers? Well, the way we do this is we take the net. So we look at the accounts receivable, it went down by 200,000. So accounts receivable went down. So we always have to think about this when we say, okay, accounts receivable went down. So that means people had money they owed us. And instead of continuing to owe us, they took money out of their pocket and put it in ours. So we had, and we wrote down the accounts receivable. Because the accounts receivable went down, it means that we got paid. Now, some of you might be saying, whoa, hey, what about bad debt expense and writing off these accounts? For this class and this example, we're just going to keep it simple. Absolutely, bad debts being written off is going to be another way that accounts receivable can be written down. To ease complexity and just for the understanding and computational reasons for this class, when accounts receivable are written down on these kind of problems, we're going to assume they're related to cash payments. So it was at 500,000 and then they have fewer outstanding customer accounts. So they only have 300,000. That means it went down. That means they actually collected an additional 200,000 more than what they have in sales. So we have sales. And what we're going to do is we're going to add the change in account receivable. This change in accounts receivable related to sales. Sales can be made in cash or accounts receivable. So the change in accounts receivable lets us know that whatever we added to accounts receivable, we reduced accounts receivable by $200,000 more. And so the total net cash collected from customers is $8.2 million. Okay, so some of you say, well, why? Why is it that we can just net the cash collected and get there? So that's what the point of this and this video is. So if we look at this and we'll just move over the net cash collected over here and let's get the journal entries for what could be the journal entries for all the accounts. Now, granted, in a sales period, you're not going to have one journal entry like this. You're going to have multiple journal entries, but we could collapse them all. We'll just collapse them all just for simplicity and just for showing this example. Imagine we just had one journal entry. How about that? One journal entry for a sale of, and some was paid in cash and some was paid in accounts receivable. But we don't know what the cash and accounts receivable are, so I've represented those as Y and X. We then also have other accounts that get paid off. This is the other type of journal entry that we could have for the period related to cash and customers. So we have customers that have paid us in prior periods, and maybe even in this period related to that prior journal entry over the year, we have these accounts receivable that get collected on that are a mix of maybe current and prior periods and maybe super old ones too. And so there's a mix there, and we don't know what they are, but we do know that debits equal credits. And for those journal entries related to paying off accounts receivable, we're going to represent that as Z dollars. So we don't know what it is, but we're going to say it's Z dollars. And we're going to just write down so it's clear the T account for the accounts receivable. And we have the beginning balance of 500,000 and we have the ending balance of 300,000, and accounts receivable is an asset. So it's always going to maintain a debit balance in the account. So it's an asset. We debit it to increase the balance and credit it to decrease the balance. And we have X equals the new accounts and Z equals the old accounts. And this makes sense, right? Because X, accounts receivable X, is the debit up here, as you can see, and the debit down here in the table corresponds to this debit in the journal entry, right? Debit accounts receivable, that means this dollar X is going to go at this part of the accounts receivable T table. Now, Z equals old accounts. Z equals old accounts. This Z right here is a credit. So there's a credit for Z dollars and naturally a Z credit to this T account right here. So this journal entry, this is where the Z shows up, and this journal entry is the X. And this makes sense from a T account perspective, just as a quick refresher. The X represents all the new accounts that are going to be debited, and the Z represents all the other accounts that are going to be taken off. So let's go through and solve for each one of these. So remember, we found the net cash collected, but let's see what these accounts are. Now, we might have to make an assumption or just a guess. Let's take a guess, and I'm only using this number. You can try this with any number. You want to use $22, you want to do $2 million, you want to do $1, $2, $3, $4, $5, $6, $7. You can do whatever you want with this. I do this just so that you can see the simplicity. Pulled the $2 million out of thin air, but 2 makes it easy to do the math so that you guys can follow along. So let's just assume account receivable could be anything. So this is a proof of this working. Accounts receivable could be anything. So let's just take a guess. Accounts receivable is 2 million. And let's assume we know accounts receivable are 2 million. Granted, all we care about is the cash on the cash flow statement. So let's say we added 2 million of new accounts receivable debited. Well, if we did that, we would know what the X is. It would be that 2 million that gets added to the T account of accounts receivable. So 2 million gets added to the accounts receivable from the debits of that year. This is what we're assuming is all the new accounts receivable. And again, we just pulled that out of thin air. It's not a real number. It's just something we guessed on for the sake of this proof. So now that we have the beginning balance of 500,000 and 2 million added, and then the ending balance of 300,000, we can say what was taken out. Also, if you look at the first journal entry, we have 2 of the 3 components of the journal entry, so we can also solve for Y. We have sales being credited for 8 million, accounts receivable being debited for 2 million. This means by default, the cash collected under this assumption is 6 million. So cash collected is going to be 6 million for Y. Okay, so cash equals 6 million for Y. We put 6 million up here as our debit for cash. So we have some of that cash. All right, so we have that, but we still need to solve for Z. So let's solve for Z. Z is all the old accounts that were paid off in that second journal entry for debit, cash, credit, accounts receivable. We need to find out how many accounts receivable were credited. Well, if we take the 500 plus the 2 million minus the 3 million, we get $2.2 million was taken off of the account. So $2.2 million of accounts receivable was paid back. Now, again, we just pulled the new account number out of thin air, but you'll notice if we put this in the journal entry, we now can solve for what the cash is because the debits have to equal credits. Accounts receivable went down by 2.2 million by being credited. And so as a result, we know cash was debited 2.2 million. And as a result, if we take this 6 million and put it up here, and then we take the 2.2 million and put it up here, guess what it equals? That 8.2 million. This 8.2 equals this 8.2 here, and we just made up the 2 million. So you could make up any number, and because of the rules of accounting, because of the laws of the accounting universe, you're going to always end up with this $8.2 million here for the cash collected. So that's why netting accounts works. But some of you might say, oh, hey, Kyle, I don't know if I buy that. Well, here, I made up another number and I went through and I did the entry differently so that the number was 1, 2, 3, 4, 5, 6, 7. So you could see that I wasn't playing some funny business with the 2 million. You solve for Y. You get this as your number 6.765433 million for if you solve for Y, and then you put that there, you can solve for your cash, the cash on the debit, and then you solve for Z using the same made up number and the new account and the ending balance, and you get Z equals 1.434567, and you put that as your cash and your accounts receivable, and then all of a sudden, guess what? And that's going to be on the other side of your accounts receivable account, and guess what? If you add up the cash of 6.765433 plus the 1.434567, you still get $8.2 million. So it doesn't matter if we pull this number out of thin air and it's round or not. This is the rules of accounting. So that's how netting the accounts works. Now, some of you are looking at this and saying, well, okay, hold up, wait a minute. You do this for sales, but let's do it with cost of goods sold where you have two accounts that you're netting. Can it work there? Well, this is a little bit more complex. So we'll go through the example just so that you can see it and see how it's done and see that it works. Granted, again, you don't want to do it this way when you're figuring out a problem. Okay, you don't want to do it this way, but this is for those people that feel like, oh man, I don't know if I understand what's going on here and why we're doing it. All right. So in the future, the other videos that you'll see that I'm posting have a much easier way of doing this. This is just a way to proof it, just a way to show you the mechanics. This is just, some of you don't want to know what's under the hood in your car. You just want to turn it on and drive. All right. If you're interested in just turning it on and drive, you can skip or fast forward this video. But those of you that want to understand what's under the hood, see how the alternator connects to the timing belt and all the other stuff, that's what we're doing here. We're just showing you what's under the hood a little bit more. So how much cash do we pay our suppliers for inventory? This is a little more complex because we're going to have to net two accounts because two accounts are involved. The accounts receivable and the inventory. So we have to take our cost of goods sold and we have the inventory that we basically purchased with cash, and then also inventory that we purchased on account. And you're going to need your accounts payable to get to that inventory number to figure out what was paid in your inventory account on cash and on account. So you need both. And you need to net both. So our cost of goods sold reduces our income. So it's in brackets of 6 million. Our inventory increased from 600,000 down here to 800,000. So it went up. Our inventory increased. That means we have less cash. Now you always have to sit and think. Inventory goes up, it means that you paid more for that inventory, so you're going to have less cash. You might be saying, well, didn't you just say that inventory is paid for with cash and accounts payable? Yes, absolutely. So you have to know what's going on with your accounts payable too. So we're going to take the net balance in accounts payable. Well, accounts payable was at 200,000 and it went up to 500,000. That means we got more inventory without paying cash. So essentially, we have more cash related to the inventory than we thought before because we thought maybe it was on account. So if we take the net accounts payable of 300,000, that suggests that we have more inventory that we didn't pay for in cash. So because the accounts payable goes up, we owe more money. We haven't paid the money. We owe the money to these other people. So the cash is in our pockets. So we need to have accounts payable representing cash, a cash flow increase of 300,000. And it might be odd for you to think about this, but you have to think about it in a way related to cost of goods sold. Cost of goods sold is done periodically on a periodic inventory system where we say, okay, well, what's the inventory we had at the end of the account? All right, well, whatever left is cost of goods sold from beginning what we added, whatever was left is cost of goods sold. And cost of goods sold, whatever gets added to inventory is going to be made up of accounts payable and cash. And so we have to figure out that accounts payable to get to it. It might be a little bit more clear as we get into the T accounts. So if we take the 6 million, we again subtract the 2 million and add the 3 because the 6 is reducing our net income number. This inventory number is also going to be a cash flow reduction, and then accounts payable will be a cash flow increase because we received more inventory on account. The cash paid is only 5.9, not 6, 5.9 million. And so you have the same question. Why? How does this work? Well, let's go through it. I'm going to use the same T accounts. Accounts payable, remember, is a liability account. So it maintains a credit balance. Accounts payable is a liability. So we have a beginning balance of 200,000 as represented here, an ending balance of 500,000 as represented here, an inventory beginning balance of 600,000 represented here, and an ending balance of inventory of 800,000 represented here. So I'm going to move this balance sheet off the page really quick, and I'm just going to move these T accounts so it's easier to kind of see what's going on. Now, this is going to be pretty complex and messy. I apologize. I'm trying to make it as simple as possible, but this is the organization for it. So how does this work? Well, let's look at the journal entries that are associated with inventory and how they get there. We add inventory to our account with inventory Z with accounts payable Y and possible cash of V. And then we have accounts payable of Q that get paid off over the period with cash of Q. So these are the two different types of journal entries that we have. And of course, we have inventory that leaves related to cost of goods sold. I didn't put this here, the inventory that, we debit cost of goods sold and we credit inventory. And when we debit cost of goods sold and credit inventory, we get that 6 million there. I didn't put that journal entry here because it's already obvious and there's nothing to solve for. We know what's in that inventory. So we need to solve for what Z, we need to solve for Z, the new inventory. We need to solve for Q, the old accounts payable, and we need to solve for Y, the new accounts payable. So the Y here is the credit right here. We need to figure out what that credit amount is. We need Q, the Q is the old accounts payable, Q right here, and we need to figure out what that is by backing into it. And then we have this new inventory. This new inventory is Z, and we need to figure out what that number is. Well, the nice thing is that cost of goods sold, the journal entry for inventory leaving the account is going to be the cost of goods sold journal entry. So cost of goods sold, that amount, that is always going to be the credit to the inventory. Now, don't get confused here. I put cost of goods sold just so that you could see it. Don't get confused by it. Cost of goods sold is on the income statement. It's an income statement balance, but I put the cost of goods sold here just so you knew where we got the 6 million in case you were looking back on it, like what's going on? Cost of goods sold. Cost of goods sold is not an asset account. It's not under inventory. It's a different account, but we use it in the journal entry with inventory. We debit cost of goods sold and we credit inventory, but I call this credit of inventory cost of goods sold just so that you can see and map it because we're running out of space here, right? So cost of goods sold reduces the cost of goods sold journal entry reduces our inventory by crediting inventory by 6 million. So beginning inventory of 600,000, 6 million exits through cost of goods sold represented on our income statement, and then our ending inventory is 800,000. Well, we can solve for Z now. Solve for Z. Beginning balance 600,000 less 6 million less the ending balance gets us to 6.2 million. Well, that 6.2 million replaces that inventory number right there. Inventory goes right there. All right, now we have to come up with a guess, and this is a guess just to make sure so that you guys can see this proof works. And I use 2 million again because it makes all the numbers easier when you use twos for some reason. So I'm going to use a rando number. It's a random number of 2, right? You could use any number you want, but 2. And I do this just for the proof. Again, don't do this when you're solving the cash flow statement problems. Don't do it. You're just going to get confused. This is for those of you that really want to look under the hood. All right. We just net the accounts like we do in the blue at the top when we normally do this. All right. So this is just for looking under the hood. Just for looking under the hood. So accounts payable and cash. Accounts payable, we're going to take a rando guess of 2 million. Well, that random guess of 2 million is our Y. Those are going to be the new accounts payable in our T account. Well, if we have that as our random guess of whatever that is, the beginning balance of 200,000 plus the 2 million, net the 500,000 will help us solve for Q. Well, solve for Q. Beginning balance of 200,000, net the new accounts payable of 2 million, add the 2 million of accounts payable, and then we subtract the 500,000, it gets us to 1.7 million. That is what ends up in our accounts payable account debited. We solve for it just algebraically, and that's not necessarily what it was. This is just what we're doing so that you can see that the actual cash paid to customers is 5.9. So that 1.7 actually ends up being part of this journal entry right here. And as a result, we know what that cash amount is. So now we know the cash related to the accounts payable. And then we also, through this, know the cash in this hypothetical example that was used in purchase of inventory. Well, we can solve for the answer now. We have cash paid in the journal entry of the actual purchase of the inventory. And then we also have cash that was paid on accounts payable for the period. 4.2 plus 1.7. It's 5.9. I told you it's 5.9. So the point of this video, again, I'm not trying to confuse you more. This is a much more complicated way of doing this, but this is just the way to see how the components work. Again, the 2 million wasn't the actual number. This is for a proof, a mathematical proof, or you can think of this as an accounting proof to just prove to you that netting the accounts works, that it works for creating the cash flow statement and understanding how much cash is there. So that's the point of this. So let's do the same thing with SG&A. We look at SG&A, and the amount that we have as an SG&A on our income statement is $300,000. That's an accrual number. We got to back out for cash and see what actually we did in cash. Well, we have a prepaid expense that increased by $100,000 down here at the bottom for SG&A prepaid expense. Well, we'd add that prepaid expense to the SG&A amount that we had on the income statement, the net difference, the delta, and we get to cash paid. That's how we would do it. But those of you that require yet further evidence, you can do this and you can solve this. You can solve this just like we have the other accounts, but that's how we do it. We net the two accounts, and the key part is knowing what's happening with cash. Well, if your prepaid account increases, how does that increase? What's the journal entry for that? Well, cash needs to be credited, meaning you have less cash. And depreciation, how much cash do we pay in depreciation? We don't pay cash in depreciation. Zero cash is in depreciation, but it's included in that net income. So we have to back it out. It's very important that you understand depreciation isn't a positive cash flow thing. It is a non-cash flow thing. And so what we're doing on the indirect method is backing that out. Depreciation is not a source of cash.